morning, good afternoon, good evening, wherever you're watching me today. My name is Peter. Welcome back to Invest with Peter. So today I'm going to be talking about, the CPI that came out last week. I'm going to be, giving my own review, what I believe is going to happen next. And I'm going to be talking about the earnings season. We've been believing that earnings season is coming, and it's always the time where investors understand that anything that comes out from the mouth of these CEOs from the reports is going to determine direction of the market. So I'm going to be talking about that. Then I'm going to be talking about the UK economy as well. It's been a big problem for people in the UK and the people of Europe, looking at the inflation and the recession that is imminent in the front. So I'm going to be talking a bit about that today as well. And also my projection for May the 3rd FOMC meeting. So firstly, let me start by talking about the CPI report that came on. So March CPI came, month over month as 0.1% versus 0.2 estimation. So it was estimated to come out 0.2% for month over month, right? But it came out 0.1%, though that's a beat. So market was happy about that, and that's why we saw market actually going up, uptrend on that very day when the CPI came out. And also the food, CPI for food, energy also, came out 0.4%. Estimate was actually 0.4% as well. So that's a good news as well. So CPI actually was very promising, and investors were actually happy about it. So for year over year, it came out as 5.0%. Market was expecting 5.1%. So everybody was like, well, this is it now. So FOMC need to, the Feds need to understand that inflation is actually coming down. They should stop hiking. Well, we don't know what they're going to be talking about. They're talking about on May the 3rd. So May the 3rd, they're going to be coming together, and they're going to be talking about where they're going to be going next, whether they're going to be raising rate by 25 basis points, 50 basis points, or they will stop overall. So most consensus believe they're going to be raising rate by 25 basis points, and most are at the camp of it's been over raised and they should stop now. To me, if somebody asks me that, Peter, what do you think about this rate of a thing? What do you think is going to be happening from here on? I would say, well, I think first of all, the Feds came late to the party. They started hiking and very late. The disease, I don't want to mention the name, that came 2020 to 2021 has been as a result of what happened. So that's why the inflation is high. That's why the economy was down and all that stuff. So they said it's going to be transitory, but well, we all understand that inflation wasn't actually transitory. So now, what are they going to be doing for the in the next meeting? Nobody knows, but people actually believe that they're going to be going 25 basis points now. But I think there's no way they have overraised this rate, and it's going to slow down the economy to an extent where the market is going to suffer to some extent. It may not be much, but it's going to reflect in the economy, and it's going to slow the economy down, even if they don't raise anymore at this point. So let's leave that one now. Let me talk quickly. I don't want to waste your time in this video. So let's talk about the earnings season. We also, NASDAQ has been, it's been up like almost 20% since it went down 2022, just after the war in Ukraine. Now, if we look at the major companies that actually was raising S&P and NASDAQ are the tech companies. And tech company will be they will be reporting from this week on to next week and to next month, right? So this is actually going to be the major caveat, the major catalyst that's going to be determining the direction of the market. Some people are saying it's going to be recession now. Ending recession means when a big company or a couple of big company reports and the report is actually bad, it's going to send the market down, and everybody will go back to reset button, and it's going to slow everything down. So people are actually projecting that, for the bears. So the bears believe it's going to be ending recession. So while the bulls are still banking on the market, the bottom is already in. So I think looking at this recession, looking at this report that is going to be coming out, big companies, if you look at the chart, Microsoft, Nvidia, Apple, and some other companies like that. Meta, Facebook. These companies are the one that have been driving S&P and Nasdaq up for a couple of weeks now. So if any of them or a couple of them actually come out and report negative earning, definitely it's going to send the market down. So what am I going to be doing? What I'm going to be doing is I'm not going to be buying anything for now. I'm going to be looking at the earning reports. If I see a glimpse of fear or panic in the report, then I will fold my hand and start banking on dividend stocks at this point, because people are actually saying, most investors, not all, are saying there's no way we can avoid this recession. It might be a mild one, but at some point it's still going to come towards summer and third quarter of 2023. I don't want to start investing now. I want to wait until I see the green light that, I think the market is going to slow down now before I start, putting money into the companies I've selected. But at the moment now, I will be banking on dividend stocks that I know will be paying me monthly, quarterly, or yearly to, be, putting that money aside to invest, in all these companies. So now this tech company are going to be reporting from this week. If you are trying to invest, I think you should probably wait and understand, the concepts of your investment. If you don't know what you want to invest in, please do not start investing at this point. All right, guys, I just want you to listen to this and watch what these analysts are talking about.
Nearly 20% in 2023, but this newfound strength is about to get put to the test come earnings season. For more on what to expect from the tech earnings this quarter, let's get to Yahoo Finance's Ali Garfinkel. Ali, what are we keeping tabs on?
Good morning, Brad. So looking at the markets, you wouldn't know it, but tech is actually on pins and needles right now. On one hand, right, you have the sense that rally looks pretty good. And on the other, there's a lot of concerns about the Fed and the sense that the sector is a little bit unsteady. So I talked to a bunch of analysts trying to understand why, and sort of a group of key themes emerged, and there were actually a lot of them. There were 4 of them that everyone brought up time and time again. And I'm just going to break them all down because there's a lot to get through. So first, number 1, the Fed, right? It's not a secret that tech was slammed by rising interest rates in 2022. And the idea that we're seeing behind this rally is that there's maybe a light at the end of the rate hike tunnel. Now, we don't know that for sure, though. And what the Fed does next will determine tech's priorities, right? So let's say the hikes continue. The focus then will stay on profitability and cost cutting. If there are no more hikes, though, we're back in business. Tech growth mode is a go again. However, we don't know that. And I think the assumption that growth mode could be a go again soon is maybe dangerous in setting up investors for disappointment. Now, next, digital advertising and cloud slowdowns. It's interesting because my inclination wasn't to put these together, but every analyst I spoke to was inclined to put these together, sort of describing them as these twin slowdowns. Now, what does that mean, right? Digital advertising, on one hand, is further in the cycle. We've been talking about the digital advertising slowdown now for 6 months, 7 months, 8 months, a year. It's been a while. However, the cloud slowdown is relatively new. In my conception, we really started talking about it. It really started hitting headlines back in Q4. I'm going to remind you of some of those Q4 numbers. Amazon Web Services actually reported a sales miss. It was a small miss, 21.3 billion actual versus 21.76 billion. However, that kind of slowdown is existential for Amazon. I don't know how many times I've said on this show that AWS is a stalwart of Amazon's business and has bolstered a lot of growth in other areas of the business. The same, to a certain extent, is true of Microsoft, which in Q4 also warned that there were going to be these slowdowns in cloud growth. So the bottom line on these kind of twin cycles is digital advertising is further along and people are more comfortable with it, and cloud is less far along, and it's made some folks out there uneasy. Now, I'll bring up AI really quick. It's going to come up in these earnings calls, but one important thing to remember about AI is that for some of these companies, there will be material effects imminently, but for most of them, those are very far down the line. I'd actually like to direct you to a PwC statistic that AI could contribute 15.7 trillion to the global economy by 2030. There's a reason that's 2030 and not 2025. This technology does still need a moment to develop. However, it is developing fast enough that we will see it discussed. And I think it's important to say AI has given people in tech a lot of optimism, a chance to think about the future after what the last year especially has been tough. Now, the last thing, of course, is layoffs. I believe, according to layoffs, FYI, about 170,000 people in tech have been laid off in 2023 so far. And what is going to happen in this earnings cycle is we're actually going to start to see some of the numbers come down about what the kind of money that has saved for these companies. I'd actually love to read you something that Andrew Boone, an analyst at JMP Securities, said to me just yesterday. We're going to see the numbers behind the cost discipline story, and that's going to be one of the drivers of stock performance over the next 6 weeks.
Because we don't know, JP Morgan actually reported a very good earning on Friday. They gave out a good report, and most people think, well, if JP Morgan report a good earning, that means banks are doing fine. I'm not going to say banks are doing fine because most of other regional banks, they gave their report and it was all over the place, and that's still giving a bit of panic and uncertainty to the market, because we all understand where when all the banks actually went through their issue, banking crisis and all that stuff. So there's no way they're going to be reporting a good earning after going through all those stuff. So I believe at this point, the only caveat we're going to be facing is the earning report, and that's going to be coming in fast and furious from this week. So now let's talk about UK economy. UK economy has been all over the place, right? If you look at the chart I'm going to be showing now, you can see that even IMF believe UK economy will contrast 2023, we're going to be going towards negative, while countries like China, countries like Asia countries will be doing 4%, 5%, while UK is going to minus. Well, I don't know why I said it in my previous video that UK among the G7 countries has the worst economy, the worst inflation, 10.4%. That's alarming. That's kind of inflation you mentioned when you're talking about Argentina, Zimbabwe. Those are the inflation, or even more than that. But when we're talking about UK, we shouldn't be going close to 10.4. When we also saw what happened in the US, inflation went to 9, and from there gradually was sorted out, and it came down to 5.0 for the months of March. So looking at that now, I think the Treasury Department, the Bank of England, Andrew Bailey, need to sort this out. And it's actually hiking, just like US are hiking as well. They are hiking the interest rate, going by 25 and all that stuff. Well, he has forgotten that United Kingdom is actually different from United States. So the problem we always have in these Western countries that they always do that copycat, doing what every other one is doing, not looking at what the nitty-gritty of their own personal economy. I don't know what UK is going to do, but all I'm saying is whenever I go to the shop and buy stuff, if I buy stuff 50 pounds this week, I go there next week, it's going to be 52 pounds or 53 pounds. That's not going to help anyone, and the government needs to do something about it. So as for me now, my advice is don't buy what you don't understand. Start going to your portfolio, look at dividend stocks that it's going to be paying you monthly, quarterly or yearly. Because if you start buying random tech company now, if it goes down, what are you going to do? So I always bank on dividend stocks, and I think it's going to help you as well. So what I'm going to be concluding on this week is that let's see what's going to be coming out from this week, and the tech, whatever the tech, start reporting, then we understand the trajectory. If everything is good, I promise you we're going to be on that green candle going up to the sky. So, well, that's all for today. But as for me, what I'm going to be doing, I'll be folding my hands. I'm not going to be buying anything. I'll be looking at the report. And once I see any slack, then I start buying into those companies. And if I see they're all good, well, I'll sit down with my dividend stock and just enjoy my dividends as it's coming in. Thank you very much for watching. My name is Peter. Please subscribe to the channel, and I'll see you on the next one. Bye for now.